understanding cash flow statements. The first point here is to understand the classifications of cash flow. We can have operating activities, investing activities, and financing activities. Operating activities are activities that are part of the day-to-day business operations of the company. For example, sales of goods and services, the cost of providing goods and services, short-term assets and liabilities directly related to operating activities. Under investing activities, we have activities associated with acquisition and disposal of long-term assets. We can have the purchase or sale of property, plant, and equipment. Or we can have the purchase of or sale of other entities' equity and debt securities. So when you buy bonds issued by other companies, those would be classified as investing activities. Financing activities are activities related to obtaining or repaying capital. For example, issuance or repurchase of a company's own preferred or common stock. So note the distinction. When a company issues its own shares or buys back its own shares, then that is classified under financing activity. If a company buys the shares of another company or buys the bond issued by another company, that would be investing. Issuance or repayment of debt, that is also financing. Dividend payments are generally also classified as financing. Now this slide is one of the most important with regards to the differences between IFRS and US GAAP. IFRS and US GAAP take a different approach towards the categorization of certain cash flows. For example, interest received. When do you receive interest? Let's say you have bought a bond issued by another company and you are receiving interest. Is that money received operating or investing? According to US GAAP, there is no judgment involved. Remember, I alluded to the fact that the US GAAP is more rules oriented. So the rule is that if you bought a bond of another company and you receive interest, that interest is shown as operating, end of story. IFRS, which is more principles based, says that a company can use its judgment and decide whether to categorize as operating or investing. So just remember that with IFRS, for these four categories, interest received, interest paid, dividend received, and dividend paid, you have two options. And you can use common sense to decide and remember what those two options are. Interest received on a bond that you have purchased can definitely not be financing. It's either operating or investing. So IFRS says pick one of the two. Interest paid, on the other hand, means that you've issued a bond and you are paying interest. Is that operating or is that financing? It's definitely not investing, right? So IFRS says that you pick one. US GAAP again says rule is that this is operating. Dividends received. This is the same logic as interest received. So you can classify under IFRS as operating or investing. Under US GAAP, you have to classify as operating. And finally, dividends paid. This is the only item where you need to remember the fact that US GAAP calls this a financing activity. It's a dividend paid to shareholders. IFRS again gives you the flexibility of saying that you can categorize it as operating or financing. So if you think about it, the only quirk or the only outlier, so to speak, is dividend paid under US GAAP. So that is financing. Everything else under US GAAP is operating, and everything under IFRS is logical. Next, we talk about cash flow statement format. Now, we've talked earlier about three categories of the cash flow statement: the CFO, cash flow from operations, cash flow from investing, and cash flow from financing. The cash flow from operations part can either be shown as the cash flow from operations can have a direct format or an indirect format. In the direct format, we essentially reproduce an income statement where we Instead of using revenue, use cash collected from customers. So every income statement item is replaced by an analogous cash item. So cash collected from customers, that's money in, and then cash paid to suppliers, that's money out, cash paid for operating expenses, and so on. And at the bottom you will have operating cash flow, which would be roughly analogous to your income as shown on the income statement. With the indirect format, you start with the net income as your top line and then make adjustments to show up with your operating cash flow. So with the direct format and indirect format, the bottom line is the same, but the top line and the middle lines are different. So with the indirect format, start with net income, adjust to reconcile net income to cash flow provided by operating activities. So you add back depreciation and amortization. Note that on the direct format there is no mention of depreciation and amortization because there you are only dealing with cash items. On the right with the indirect format, since the net income was calculated after subtracting depreciation and amortization, you need to add back. And similarly, you need to make adjustments for, let's say, the gain on sale of equipment, which is not a cash flow and it also isn't an operating activity, but it is included in net income. So you need to adjust out those items. Any changes in inventory or receivables and so on also need to be adjusted. Then the other parts of the cash flow statement, the CFF and CFI. So here there is only a direct format. We don't have any indirect format when it comes to CFF and CFI. This now is extremely important. Determining operating cash flows. Determine whether a cash flow is income or an expense. So let me just explain this through a simple example. Let's say that you have sales equal to 100 and receivables went down by 10. So what is the cash flow? What is the money received from customers? The first thing you do is determine whether this item that we are talking about, sales, is this money in or money out? Obviously sales is money in, so you put plus 100 for sales, and then accounts receivable down by 10. Notice that an increase in asset will have a negative impact on cash flow. A decrease in asset will have a positive impact on cash flow. AR down by 10 falls in this category, decrease in asset. So decrease in asset has a positive impact on cash flow. So the overall impact here will be 110. Then the next scenario, COGS is 60. Now is COGS money in or money out? So COGS is actually a negative, it's an expense. So you just put negative 60. And then we say accounts payable up by 5. Accounts payable is a liability and it's going up. An increase in liability will have a positive impact on cash flow. So you do plus 5. And then inventory down by 3. So this is a decrease in asset. That will also have a positive impact. So you put plus 3. So what is the net cash out? It's minus 60 plus 5 plus 3. So it's negative 60 plus 8, which will give you negative 52. If you use this method, then many questions of this nature will become quite easy. All right, investing activities. And as I mentioned before, we only have the direct method. This material is a little bit difficult. At the very least, I would say that you learn what I am presenting on this slide, but obviously to learn it well, you need to practice some questions. CFI, cash flow from investments, is calculated by examining the change in the gross asset account that results from investing activities. So buying and selling of equipment, for example. Typically, we are considering purchases or sale of equipment or other long-term assets. Now, to determine cash paid for new equipment, what do? we have to analyze whether old assets were sold or not. So remember this relationship. The cash paid for new equipment is equal to the beginning gross equipment balance. By gross, we mean that depreciation is not subtracted. So look at the gross amount plus the gross cost of any equipment sold minus the beginning gross amount. So the key thing to remember is that we are using all gross amounts. Now, the beginning gross equipment balance is easy. That is read straight off the balance sheet. Or the ending gross balance and the beginning gross balance, these are easy. But the gross cost of equipment sold, this is not that easy. So how do you figure out the gross cost of equipment that was sold during a given period? You take the beginning balance of equipment and then the equipment purchased minus the ending balance of equipment. And we worked through an example like this in the regular lectures. Next, to determine the cash inflow from the sale of equipment, the equipment accumulated depreciation account and gain or loss on the sale of equipment are analyzed. So you are selling equipment, how much cash do you get? That cash is equal to the historical cost of equipment minus the depreciation on equipment sold. So you can't just take the full depreciation number, you need to take only the depreciation for the equipment sold. And then gain on sale of equipment, this is easy, this comes straight from the income statement. So where does the historical cost of equipment sold come from? This is equal to the beginning balance of the equipment plus equipment purchased minus ending balance of equipment, similar to what we saw earlier. How do you calculate depreciation? It's the beginning balance of accumulated depreciation plus the depreciation expense minus ending balance of accumulated depreciation. The numbers here are based on the depreciation numbers presented in the financial statements. And again, I'll emphasize that if you don't have time, at least try to remember what's here, but to do well on the exam, you should have practiced some questions of this nature. Financing activities, direct method. This involves the flow of cash between the firm and suppliers of capital. Broadly speaking, there are two suppliers of capital, either those who lend the firm money, bondholders, or shareholders. Now, in terms of the interaction between bondholders and the firm, the net cash flow from lenders or creditors is equal to net borrowing minus the principal amount repaid. Actually, this should say the net cash from creditors is the borrowing minus the principal amount repaid. The net cash flow from shareholders is equal to new equity issued. So this is how much money the company is getting from shareholders minus shares repurchased. This is minus because this is the money given back to shareholders minus cash dividends paid. So cash dividends paid are the cash dividends paid by the firm to the shareholders. You need to remember the formulas given over here. We are talking about free cash flow to firm and free cash flow to equity. When we say free cash flow to firm, we are talking about money that goes to all suppliers of capital, lenders and shareholders. So remember these relationships. They might show up at level 1, but they'll definitely show up at level 2. So free cash flow to firm is net income plus non-cash charges. This typically is depreciation plus interest into 1 minus the tax rate minus the fixed capital investment. So these are investments in equipment, property, plant, etc. minus the working capital investment. This is the money that is flowing, or the cash flow that is available to all providers of capital. Notice that a related or essentially similar formula is CFO plus interest into 1 minus tax rate minus fixed capital investment. Because if you take net income, add the non-cash charge and subtract the working capital investment, this essentially is CFO. And then in terms of free cash flow to equity, that is the money available to equity holders. So money available to equity holders is CFO minus the investment in fixed capital plus net borrowing. Another way of looking at it is if the equity holders are paying back the debt holders, then you can also say minus the net debt repayment, because that is money going from the shareholders to the lenders. Cash flow ratios. Now this is tricky. Generally, it would be low probability to receive questions related to CFO ratios. Very often the ratios are balance sheet ratios or income statement ratios, but this can still show up. So the debt coverage ratio is CFO divided by total debt. Now this is slightly tricky, so I'll emphasize the interest coverage ratio. Normally when we think of interest coverage ratio, it is EBIT, operating income, divided by interest. Now when we look at the cash flow statement, instead of EBIT, we say CFO plus interest paid plus taxes paid. The reason is that if you think about EBIT, this is a number that is calculated before interest and before taxes. However, CFO is calculated after interest and after taxes. So to make it comparable with EBIT, we need to add back interest and add back taxes. And then with the regular interest coverage ratio, we divide by interest expense. If we are looking at a cash flow ratio, then we divide by the actual interest paid. The reinvestment is the CFO divided by cash paid for long-term assets. Debt repayment ratio is CFO divided by cash paid for long-term debt repayment. Dividend payment is CFO divided by dividend payments. Investing and financing is CFO divided by cash outflow for investing and financing activity. Hopefully you can recognize the fact that most of these ratios are based on the name. So if you don't remember based on this slide, then on the exam, try to get a hint based on the name of the ratio.